Through this video, I'll be going through what DTI is, how you can calculate it, and how you can use it to stay ahead of the curve. Your debt-to-income ratio is an important financial metric that provides a snapshot of your financial stability as well as your ability to repay your debts. As seen in the name, this compares how much income you receive with how much of it has to be used to pay off debts. And banks would use this metric to calculate whether you're in a position to take on more debt and reliably pay the money back on time. To give a general figure, lenders will usually never lend to anyone who has a DTI over 40 to 45%, and it will still be hard to get a loan if you have a DTI over 35%. And when looking to lend money to someone, banks will usually use this in conjunction with their credit score, which is a history of how reliable they are at paying back money on time. Calculating this number for yourself is not difficult, and it can help you get on top of your finances when used alongside a budget. To find your own DTI, you first have to add up all of your monthly debt payments, which includes paying off credit cards, paying off any car, personal or student loans, as well as any mortgage or rent payments. You then divide this by the gross monthly income that you receive, which is the total from all sources calculated before taxes or any other deductions are taken out. And this will give you a percentage for how much of your gross income is being used up by your debt repayments on a monthly basis. Due to the current fluctuations within the economy, such as the rising inflation in Australia resulting in higher interest rates, your DTI could be increasing without your income or number of debt sources changing. And because this metric is so important for taking on new loans, it is very beneficial to keep track of its value every few months, because then it may help you when planning out when to apply for new loans. Despite recent drops in property prices, they are still relatively high, meaning that when banks calculate what your DTI would be once you also have the mortgage to worry about, they might find that it's a little bit too high for them to justify lending you the money. So that may mean that you have to lower your DTI before you apply for that loan. And a quick sub to the channel couldn't hurt either. Lowering this percentage is essentially the same as just trying to increase the amount of money that's left in your pocket at the end of each month. You can do this by either increasing your income or trying to pay off a bit more of those debts now so that you have less to pay in the future. Using a budget alongside keeping track of this metric is a great way to stay on top of your finances while trying to bring this metric down. You also need to keep in mind that even though you may think that having a DTI under 10 is a good thing, you have to remember that debt isn't actually bad. Debt is a source of power that allows you to undertake opportunities such as purchasing investments, which will actually make you more money than you started with. You do need to stay reasonable with this, however, and stay in the middle ground where you can reap the benefits of both worlds. Better financial stability and peace of mind from having a lower DTI, and having the confidence to invest. Just remember that using debt is an advantage, not a disadvantage. That's all for me today. I've been Tom, and I'm signing off on another Tom's Morning Magic video. See ya!